Okay, hi everyone. This is going to be the lecture for chapter 10. Let me get this out of the road here. So we're looking at property acquisition and cost recovery. So one of the things we're going to see, right, is that if you remember from financial accounting, as a general rule, you're going to capitalize long-lived assets and then you're going to recover those costs over their lifetime. So traditionally, right, like you buy a building, you don't expense the thing up front. Instead, you depreciate it over its useful life. And depreciation, that's a cost recovery mechanism, right? It's how you recover your upfront cost. Now, depending on the type of the asset, right, like real property, personal property, you're going to subject to depreciation. Intangibles potentially could be subjected to amortization as the cost recovery method. And then natural resources, we would use depletion. So one of the things we need to distinguish for tax purposes is the difference between initial basis and adjusted basis. For right now, right, just assume initial basis is going to be cost, right? So maybe you bought a car, right, for $10,000, okay, right? That's your initial basis. Say you use this in a business capacity, right? And over the first year, you depreciate it $1,000, right? So you depreciate it. Accordingly, your adjusted basis at the end of year one, right, will be your cost, $10,000, minus the depreciation, the accumulated depreciation. Your adjusted basis is $9,000. Right? So that's the difference if you see those words initial basis, generally what you paid, adjusted basis, generally what you paid minus your accumulated depreciation. It's kind of like financial statements, except instead of reporting them separate, like fixed assets minus accumulated depreciation gives you net book value, you collapse them all in one. And why we care about adjusted basis is when you go to sell the asset, if you remember, right, anytime you have a disposition event, it's going to be your amount realized minus your adjusted basis gives you the gain or loss, right? So I don't know, maybe you sell this car for $15,000. Maybe it's like a DeLorean or something, and there's a Back to the Future movie and it goes up in value. Hey, your carrying value, your adjusted basis is $9,000. Accordingly, you have a $6,000 gain. Okay. This slide is just showing that, hey, there's other ways you can determine your initial basis. Most of the time, right, it's going to be your cost, right, what you paid for it. However, if it's an asset that you converted from personal to business use, it's generally going to be the lower of cost or its fair market value on the date of conversion. If it's from a tax deferred transaction, things like a like kind exchange, generally there'll be a carryover basis. If it's a gift, right, generally going to be a carryover basis. So the donor, right, so if you get a gift, right, say maybe grandpa bought a watch for $100 and he gives it to you as a gift, well, your basis in it is now his basis, right, $100. And if you inherit something, it's generally going to be the fair market value on the date of death. So hey, grandpa bought it for 100. When he died, it was worth 1,000. You inherited it. Your basis, your initial basis, will be 1,000. Different ways to acquire the asset. So with that kind of being said, right, as a starting point in tax, overall, just like in financial accounting, you have to capitalize long-lived assets. And one thing to kind of just be aware of here up front, this chapter is sort of a blend of individual and business. And what I mean by that is individuals would typically see depreciation on their Schedule C, right? So if all you have is a W-2, you just work a wage job, none of this is applicable to you. It's generally going to be self-employed taxpayers. And likewise, you're going to see it for businesses. So one thing, right off the bat, we need to separate personal use assets, things in your everyday life, you don't get deductions for, right? So like the clothes on your back, the car you drive every day for fun, your boyfriend, your girlfriend, right? Generally, the tax law does not give you personal use deductions. Only if you get a deduction if there's a business expense. So here we're talking about business assets. As a starting point, the general rule is you got to capitalize long-lived assets, right? Put them on the balance sheet. Do not immediately expense. But we will see there are some giant holes to this, giant exceptions, right? It's kind of like Swiss cheese. There's more holes than there is actual cheese. And the first exception we're going to see is this de minimis exception. Essentially, it says, hey, if you have relatively small expenses, 5,000 or 2,500, depending on if you have audited financial statements, you get to immediately expense those, right? So, hey, I have a business, I'm self-employed, I buy a computer for $1,000. Technically, that's a long-lived asset. Technically, I should capitalize it. However, it's a de minimis item. Accordingly, I can immediately expense it. All right, once you kind of get the asset up and running, you then need to distinguish routine maintenance, which you immediately expense, from capitalized improvements that you have to capitalize. So this is a good kind of thing here to show you what's going on, right? So as a summary, right, your initial basis is this guy right here. It's basically, for purposes of right now, it's cost plus. And what I mean by that is it's your cost plus any of those other costs to get the asset ready for use. Basically, all the money you put into this up until you flip the on switch, that's part of it. So, hey, let's say we buy an ice cream machine, right? We pay 1,000, we pay 200 for shipping and sales tax and all these other things. Our initial basis is $1,200, okay? If we throw money into it, afterwards, we need to distinguish, hey, is this routine maintenance that's immediately expensed, or is it a capitalized improvement that will depreciate separately? This would be obvious if it's tested on the exam, right? If it's like a small part or something, right, we're just getting it cleaned to the machine, expense that. If we need to replace the entire inside of the machine, right, it's a giant change, a giant improvement, that would be capitalized. In any event, right, say we're carrying it at $1,200. In year one, we depreciate it by 100. Accordingly, our adjusted basis will be 1,100. Why we care about that is, hey, if we sell it, we're going to use the amount realized minus our adjusted basis. That gives us our gain. Okay, so let's talk about depreciation, right? We're going to really be focusing the rest of this chapter, on that part of it, as well as other cost recovery mechanisms. So one of the things here where you calculate depreciation is on this form 4562. In the outlay of it is essentially on the top, right? You have 179 in bonus, and below that you have makers, which is another type of depreciation. The 179 in bonus are basically an accelerated form of depreciation. This is the second in the giant hole in the Swiss cheese. Most of the time, long-lived assets you get to immediately expense, whether it's through 179 or bonus. Whatever is left over right after you expense that, like kind of the cheese part of the Swiss cheese, that will be subject to makers depreciation. Okay, so this is a very important slide. We're going to keep referencing it, but let's look at the 4562, right? So here's the tax form, 4562. 179 in bonus, right? That's like your blue shell if you play Mario Kart. Most of the time, you're going to be able to immediately expense all or a significant portion of the assets you buy, the big hole in the Swiss cheese. The leftovers, right, you hit with the green shell, the maker's depreciation. Okay? Now, this is sort of an academic view of that 4562, right? You got the blue shell up here, and you got the green shell down here. How we are going to unpack this, right, is we're going to look at maker's depreciation first, and then afterwards examine the blue shell, the 179 in the bonus depreciation, okay, because that's just the way the book sets it up. But let's start with makers depreciation, right? So first off, the idea with this makers, it's the modified accelerated cost recovery system. That's just a fancy way of the IRS saying, hey, here are our rules to depreciate property. And essentially, with these rules, right, again, we're talking about uh, business use property. So we're talking about personal property used in a business, right? So things like a car, a truck, a machine, equipment, as well as real property used in a business, right? So maybe like, an apartment that we buy to rent out for an Airbnb or an office building that we buy, right? So it's personal property used in a business and real property used in a business. If it's in everyday life, namely personal use property, one little word there makes a big difference. You do not get depreciation. Okay. But the idea with this is with makers, which what we're going to be examining first, step one for personal property and real property used in a business is gathering our materials, right? So what materials do we need? It's like a recipe, right? Step one, get your materials. We need these 5 things, right? 1, 2, 3, 4, 5. We need to know what is our depreciable basis, right? That's essentially going to be our initial basis or cost. We need to know the date we placed it in service, right? When did we flip the on switch, right? We need to know the depreciation method, right? So what's the idea for this? Well, for personal property used in a business, right? Like a car versus real property, the general rule for the depreciation method is going to be 200% declining balance. For real property, it's going to be straight line. We then need to know the recovery period. And again, this will be given to you, the recovery period. For personal property, it's generally 5 or 7 years. For real property, it's 27 and a half or 39, okay? And then we need to know the convention, right? For personal property, the general rule is half year. The exception is mid-quarter. And for real property, it's going to be mid-month. All right, so these things, a lot of these aren't going to make sense to you right now. That's totally fine. Just be aware, hey, step one, we're trying to calculate depreciation. We need to gather these 5 things. Depending on whether we have personal property or real property, we could have different rules. All right. So let's start with personal property, right? We're right here, we're starting with personal property. This is, like I said, it's going to be things you use in a business, right? So like a computer, an automobile, furniture, machinery, equipment. The general rule for the methods, right? So we got to step one, collect our items. Well, we know our initial basis, what we paid for it generally. We know the date we placed it in service. The method is generally going to be 200% declining balance. So like double declining balance. What this means, if you were to graph it, right, you get a lot of depreciation in the early years, lesser depreciation in the later years. That's the idea with it. You can read the notes below there. The next thing for personal property used in a business, right? The recovery period is generally 5 or 7 years. That would be given to you on the exam, and that applies to used assets as well, right? So, hey, a truck, you would think 7-year property. If you buy a used truck, it's also 7-year property, okay? Then we need to learn about the convention, right? Are we using the half-year convention for personal property or the mid-quarter convention? What does the convention mean, right? Well, this essentially tells you how much depreciation you get in the first year you own it and in the last year, right? Whether you sell it or you keep it. Now, one of the things here, right? What does this mean? Why do we even have this convention? So if we were to draw this out, right, like here's a current year. If you remember from like your financial accounting class in depreciation, things are usually pretty like neat and cute and easy, right? Like they conveniently put everything in service on January 1st. It's not the way the real world works, right? Like in real life, businesses are placing property in service all throughout the year, right? So this becomes a headache because you got to calculate depreciation sort of pro rata for each one of these, right? Like, well, maybe this one we had it in service 300 days. This one we had it for 290 days. So it's a headache. So what the IRS does is they come in and they say, look, we know that's a headache. So what we're going to do is, right, we are going to use this half year convention. And instead of making you trace these out and figure out the number of days, we're going to say, look, no matter what day you put an asset into service, we are going to treat it as if you put it in service in the middle of the year. So it'll be relatively clean. Hey, you just get half of a year's depreciation on it. However, right, what's the upshot of this? A lot of people, right, you get a sneaky person and they're like, oh, well, it doesn't matter where I put this into service. Well, then on December 31st, I'm going to just put all my assets into service, right, one day, but I get an entire half year of depreciation. If you do this, right, so the general rule is the half year. The exception comes in and says, hey, you try to game the system. That is to say, you put more than 40% of your total assets for the entire year in quarter four, then we are going to use the mid-quarter convention. And what the mid-quarter convention says is, hey, each one of your transactions, right, maybe you put something there, and then you put a couple at the end. We are going to like indicate which quarter did I put that in. Quarter one for that guy, quarter two for this guy, quarter three for these guys. And then we're going to treat it as if you put it in the middle of that quarter, right? We're not going to just lump everything in the middle of the year. We're going to have to individually dissect these, okay? So that's the idea with the convention. It tells us how much you get in the first and last year, okay? Now, what's the test for this, right? The mid-quarter, if you put more than 40% in fourth quarter, we got to flip to that. Let's kind of pivot here a little bit and talk about actually calculating depreciation, right? So it comes down to, and again, if you know this little chart, it's helpful, right? You need to know, and what I could say to you on the exam is, here is a business that is using personal property, a car. Here is a business that has an apartment that it's renting out. Can you please tell me depreciation in the first year? Can you please tell me depreciation in year 2 and year 3? Can you please tell me depreciation in year 6 when you sell the property, right? So that's what we're going to unpack here, each of these kind of calculations. And for tax courses, right, I'm going to be teaching depreciation through use of the tax tables, right? In other words, there isn't going to be a manual calculation here like you might do in your financial accounting, right? You've already done that in financial. I'm teaching you how to do it in tax. So with this, right, the first thing you got to do, right, we said gather your materials. Then you got to figure out, does the half-year convention or the mid-quarter convention apply? The 40% test, right? Most of the time, the general rule is going to be half year, right? So when we're looking at this, right, let's just assume that half year is in play. What we then do is we're going to use the half year table, right? So that's the table that you're going to use. And essentially what you do is you say, oh, is this 3-year property, 5-year, 7? Oh, it's the first year. That gives me the percentage. I multiply it times the asset, right? So let's look at example 10.4 to show you what's going on here. Right, so let's say that we are just looking at this office furniture, right? Say step 1, they gave us our materials, right? We know that we paid 20 grand for this. We know we paid, it was February 3rd. and let's just say that we know we're using the half-year convention, right? We we passed the 40% test, right? How do we go about calculating year one depreciation, right? Because I'm worried about this guy right here, first year. Well, essentially, we use the table, right? What I mean by that is we do, hey, 20,000 times 14.29, right? We're looking at here 7-year property, first year of depreciation. There we go. Simple equation. Multiply them. There's the first year of depreciation. Okay, 2858. How do we do the subsequent years, right? Because I need to put, right, I put my little check mark there for first year. How do we do year 2, year 3, year 4? Not that hard, right? We continue to use the table, right? Here, 14.29. In year 2, it's 24.49, right? So just take 20,000 times 24.49. There we go. One thing to be aware of here, right? You keep it at that gross cost. In other words, what you do not do, what would be wrong in error, is if you back out the accumulated depreciation. You would do that if you manually calculated it here. However, the way the IRS tables are constructed make your life a little bit easier, right? You just keep using that initial basis number there. Okay. So we talked about first year, use the table, 20 grand times 14.29%. Second year, use the table, 20 grand times the percentage. How do we figure out our depreciation in the year of sale, right? Well, one of the first things you got to be aware of here in the year of sale is what convention we're using. And what I mean by that is it half year or mid-quarter. An interesting little tidbit, right? Tax thing, a little puzzle, right? Why, if we have 3-year property, are there 4 years of depreciation? Well, the idea with this is it's the half-year convention. In other words, we're giving you half a year up front, half a year on the back end, and then full year, right? So 1, 2, add them together, that's 3 years. Even though it's over 4 years, we split the baby in year 1, okay? So the setup with this becomes, right, what do we do in the year of sale, right, in the year of disposition? So if I bring my little chart down, I hope, nope, that's not it. Where is it at? Here it is. Let me bring it down. Right, what do we do, right, the year of disposition? Well, essentially what you do is you do full year of depreciation. So you just use the table, $20,000, whatever the basis is, times the percentage. And then if it's half year, you multiply it by 50%. So let's look at an example here and kind of say, hey, why are we doing this, right? So, okay, say that we're building off that example, and instead of keeping it the entire year 2, we sell it in year 2. So I say to you, hey, can you please tell me the depreciation in year 2 if we sold it? Hey, we're using the half-year convention. So what we got to do is figure out an entire year of depreciation, use the table, and then multiply it by 50%, right? Because why we do that is you don't get the entire year of depreciation in the year of sale. You only get half of a year, namely 50% of depreciation, right? We got to satisfy that convention, all right? So first year, use the table. Second year, use the table. Year of disposition, use the table, multiply the answer times 50%. Now, if you keep, and this is an important note, right? Like say that you were to keep the asset all the way till year 4, right? In year 4, you just use the table, right? In other words, you do not, if you just run it through its useful life without selling it, multiply it times 50% at the end of the year. That's already built into this table. Stated alternatively, the only time, right, you got to do a little bit of math is if you sell it. The rest of the time, you can fully rely on the table. All right. So let's then move to the mid-quarter convention, right? Say you aren't using the half-year convention. You put all those X's into the fourth quarter. Then what do you do? Well, let's look at example 10.7 to show that, right? Because it gets a little bit tricky for there. All right, let's say during the year, right, we put all these assets into service. 1, 2, 3, right? First quarter, third quarter, fourth quarter, here's the values, right? So in total during the year, we put 655,000. We look and we say, hey, how much did we put in the fourth quarter? 610, right? So 610 out of 655. Hey, guess what? 93% of our assets we put in the fourth quarter, right? That's greater than 40%. Therefore, we now must use the mid-quarter convention. And what the mid-quarter convention does, right, it's going to punch you to these tables over here, right? And there's a table for things you put in service in the first quarter, the second quarter, the third quarter, the fourth quarter. If this is tested on the exam, right, I'm going to give you the tables, obviously, but you're just going to get a giant PDF that has all the tables. You need to be able to identify which table to use. Okay? So, with this, right, if we go into 10.7, how do we figure out depreciation in year one? Well, hey, we have to individually sort it, right? The office furniture, we put it into service in quarter one. We're using mid-quarter. Accordingly, we use the first quarter. Table, year one, 7-year property, there we go. The machine, we're using the mid-quarter on. We put it in service in quarter four. We got to use that table, right? You just individually analyze it. So again, for the mid-quarter convention, right, first year of sale, use the table. Subsequent years, use the table, right? It's very simple, right? Once you find the table, you just move down. Where it gets tricky is in the year of sale, right? So in the year of sale, you use the table, but what you multiply it by is a percentage from another table. And that's what this guy right here, right? How do you figure out what's going on in the year of sale? Well, hey, you figure out the full year, right here, and then multiply it times the percentage from the table. Essentially, you look at, hey, in the year of sale, did I sell it in the first, second, third, or fourth? That gives me the percentage that I multiply it by. Okay, so you can look at 10.7, 10.8 there for more specifics. I'll be honest, on the exam, I'm more concerned with the half-year convention, but do be aware of the mid-quarter convention, right? Does it apply? Did we put more than 40% of our assets in the service in the fourth quarter? Then we get punted. We have these 4 tables to know what to do with it. All right, next, let's move to real property. So same setup here. Step 1, we got to gather our materials. There's 5 items. Then we got to figure out, and I could ask you on the exam, could you please tell me the first year of depreciation, subsequent years, or depreciation in the year of sale? So with real property, the first thing with this is you got to be aware that land is not depreciable, right? So if you saw something, right, where it's like they spent 100 grand on a building, 30 of it represented land, right? Well, 70 of it, the building is depreciable, right? In other words, this is the number you're running the depreciation calc on. It would be wrong if you did it on 100. You got to back out the land from the gross price. That would be explicitly told to you. Now, when we're talking about real property, there's 2 types, right? You have residential and non-residential. Is this property capable of somebody living in it or not? Is this an apartment building we're renting out for someone else to use, like an Airbnb we're trying to make money on? Or is this, a business use property like our warehouse, like our office building? If it's residential property, right? So like an apartment building that we buy to rent out, 27.5 year. If it's non-residential, right, like a warehouse or our office building, 39-year recovery period. Okay. How do we go about, right, gathering our materials, right? Our step one, we got to gather our 5 things. So it's a little bit easier with real property in the sense that it's using the straight line method, and we're using the mid-month convention, which basically says regardless of whenever you put it into month, you put the building into service in the month, the 1st, the 2nd, the 28th, the 29th, we are going to treat it as if you put it in the middle of the month in service on the 15th. Okay. As we've indicated, right, we have 27.5 and 39-year recovery period, and we have the convention here. So how do we go about calculating it, right? Because there's 3 things I could test you. What's the first year, the subsequent years, and the year of disposition? The first year and the subsequent years, we just use the table, right? But again, you got to be able to identify the table. Is this residential property, right? An apartment? Then you would use this table. Is this a warehouse, right? Then you would use that table, okay? So you need to be able to identify them. Let's look at an example here, 10.9, 10.10 to kind of build this out, okay? So all right, hey, it looks like we have a taxpayer with a warehouse, so that's 39-year property. They place it into service on May 1st, so you kind of have to be aware of on the front end in year 1, what is the month they put it in service. They want to know, can you please tell me year 1 and year 2 of depreciation? So we know we're using the table, right? It's going to be the cost times the percentage from the table. Okay, but how do we use this table, right? That's where it gets a little bit tricky. So first off, we're given 2 tables, right? We go back here, which one do we pick, right? Well, they told us in the facts that it's non-residential, right? So that's the avenue we're going to go down. They also told us that we put it into service in May, right? The month the property was placed in service. They want to know year 1, year 2 depreciation. Hey, there's the percents, 1.605, 2.564. Cost times the table percentage, cost times the table percentage. There you go. If it was an apartment building, right, 27.5, you can see, right, we just snag the numbers from the table there. So again, reading, if you're looking at a real property depreciation question, what are some things to consider? Is this residential or non-residential? That tells me what table. What month did I place it in service? Because that tells me how to use the table. Right here it was May. May is January, February, March, April, May, 5th month. We're going to use the number 5. Okay, where it gets a little bit tricky, right? So we talked about year 1, right? In year 2, just use the table. In the year of sale, it gets tricky, right? And essentially what you do is you figure out a full year of depreciation, use the table, and you multiply it by this little formula here, right? The month number that you sold it minus 0.5 over 12. That's a mouthful. You can just memorize it. What is it doing? That's a way to satisfy the convention, right? In order to give you only half of a month in the month of sale, we need to modify the table, right? The percentage from the table. It doesn't calculate that. So let's look at an example here. All right, so we had that warehouse, right? And it looks like we sold it in March of year 2. They said, can you please tell me the depreciation in the year of sale, right? So basically we're going to use the table, right? And we will figure out depreciation for the entire year, right? So 39 years. Let's see here. May was when we bought it. We placed it into service there. 2.564. There you go. That's for a full year. However, right, we didn't keep it for a full year. We sold it. Let's see, how many months into the year? In March there, January, February, March. So what we got to do is a little bit of math, right? So we sold it in March, 3 minus 0.5, right? Because you only get half of a month in the year of sale is 2.5. 2.5 divided by 12 gives us 0.208. Multiply that times the full year. Hey, there's our depreciation in the year of sale, right? It's basically a full year, in this case, times the 2.5 months out of the 12 months of the year, right? That we're going to account and give you depreciation for. All right. So that's the setup, right? It's not, let's see here. It's not super complicated. It's hard in the sense that, yeah, there's a lot of different like tables in play and you got to be careful with it. But if you go slow, right, and you can just be organized, it's not that bad, right? So a quick 5-minute summary, we're talking about makers depreciation. There's personal property used in a business and real property used in a business. You need to gather your materials, right? We're going to need, if we go back here, let me kind of zoom up and see if I can find that slide. It's up here further up, right? We're going to need the basis, right? Which essentially your initial basis, what you paid, the date you place it in service, I'm sorry, I'm jumping all over here. We're going to need the method, the recovery period, and the convention. Right? The method, the recovery period, and the convention. Okay? Most of these are going to be given to you. The only one you may kind of come in a fork in a road is the convention. But with it, right, the basis is what you paid, and the date and service is when you put it in service. Right? Those would be like in the facts. The method for personal property, 200% declining balance, straight line for real property. The recovery period, right? Generally 5 or 7 years, and then 27.5 and 39. The convention, generally half year. If you fail that 40% test mid-quarter, for these guys, it's mid-month, right? We basically say, hey, we're not going to look at when you actually place it in service. We're going to make your life a little bit easier. That was a headache, and we're going to try to help you out. With this, right, you need to know for personal property, I could say to you on the exam, can you please tell me the first year of depreciation? Use the table, multiply times the percentage. Subsequent years of depreciation, use the table, multiply it by the percentage. Can you please tell me depreciation in the year of sale? You're basically going to use the table. You're going to multiply it by 50% if it's the half-year convention in play, or a different percent, the other table would be given to you if it's mid-quarter convention. Okay? Just keep it simple like that. Don't overcomplicate it. If it's real property, same setup. Can you please tell me depreciation in the first year? Use the table, multiply it times the percentage. Make sure you're using the right table, 27.5 and 39. In subsequent years, use the table. And then in the year of sale, right, it's the table, the full amount for the year, times essentially the month number, right, when you sold it, minus 0.5, because we're only giving you half of it, divided by 12. So in our case, in that example, right, hey, you only get 2.5 months out of 12. So with that, we're going to end it here. You can rewind this, watch it slower. This is a good one if you're like stuck on the homework to kind of slowly watch.